Hello students, this is chapter 4, that is banking and monetary policy overview. I hope you have watched all the videos. If you have not watched, just quickly go through it and you need to revise it up, and for this revision I have made an overview, so you just go with this video also after looking all that particular videos in detail. So let's start with an overview, that is chapter 4, banking and monetary policy. Now, how does this banking, in that banking word bank comes and how it is made? It is talk about English language. Bank means heap or mass. In Sanskrit, this word is known as bhanda, which means a collection of capital or fund. Then comes in English word again, which how this bank came. The word bank came from the Italian and the French word, that is banca and bancu, which means that it is a bench of money exchange. It is a very well bench where you find that was a money exchange system was going up. It is during the time of European time where they started with first their currency notes, and their internationally money were being exchanged. So all this particular thing was been going up, and that time from the European time only, or from the European side only, this particular bank came up. Then you find that the first real bank name is Bank of Barcelona, which was set up in Spain in the year 1401. So main purpose is what there arose a need of people, because to exchange, as we have seen that the previous chapter, so you find that money came up, and in that money the banking system came up, and banking system took up this particular money policy as a main thing, and money became the most acceptable medium for exchange of goods and services. So here this particular, so there were so many institutions which been made so that we can keep money as a safety, we can maintain that particular value of money, and all this particular thing functions are been done by the banking system in the that those years. Then comes the meaning of bank. So there are three types of meaning, or three different uh, types of meaning which has been given up here. So if it is asking for 1 mark, you can write down for 1, that is bank is that institution which provides service of banking. Suppose it comes with the 2 marks, or a proper definition which is having 2 marks, you can write either second or third meaning. So bank is an institution authorized to collect people's saving or deposit with the purpose of lending, and those of condition in returning the same with the depositor's demand. So if it is meaning, you have to write correctly. So you find that here it accepts the deposit of the people, or the savings which have been done by the people, so that this bank will give in return something as an interest, as well as this there's a condition that whenever this particular customer demands, they need to pay back them as and per the demand of that particular customer. Then comes the third meaning, it is a commercial organization. Why commercial? Commercial means they earn profit. So here is functioning for profit, which savings in the form of deposit and pay interest in return. So you find that when you keep your money in the bank, you get at the every quarterly, that is every 3 months, you find there is a interest which is been given to you. It ensures you that there is a safety, because you feel that your money is not safe at your home, but it can be safe at a bank. So you try to keep your money. Your parents must be keeping your money at the bank, so that particular gives you safetyness of the money, and that's why we find that this is a commercial organization. So they charge interest, they charge interest also, and they give interest also. Those who are taking loan from the bank, they charge interest, and those who are keeping their or depositing their money into the bank, they give interest. So this is how it has been happening, and this helps various sectors for the development of the nation. So this is what third meaning which has been broadly said. So these are the three meanings. Now let's go with the classification. There are two types of classification. You find that it is commercial bank and second is central bank. So first we'll go with commercial bank. Commercial bank means it is a bank in which bank is one which transacts the business of banking, that is accepting deposit from the people for the purpose of lending. Why they accept? Because they want to lend to the other people. So your money is being taken by bank, and that money is being given to another person, so that the another person can develop for their own business or any other thing, they can get money for them. So for purpose of lending, investment, or repayable on demand, otherwise, and withdrawable by check. So whenever you want to withdraw your money, you can withdraw by check, pay order, or other means of thing, so that you can go with your money. So this is what it is according to the Banking Company Act 1949. This definition can also come with a 2 marks question also. So remember, according to Banking Company Act 1949. Then there are the few functions which I already studied, the primary function and the secondary function. So primary function, again, it has been divided into 5 categories. So you find here, that is, first is accepting deposit, second is providing facilities, payment, withdrawal, credit creation, interbanking transactions. Then comes the secondary one, that is agency and utility services. And second point is, that is, provide various facility with changing time. So quickly go with accepting deposit. What is happening? You find that you're saving money which has been accepted by bank. So you try to keep your money safe in the bank. You feel that your funds are safe. So bank becomes a custodian, as well as you find that when if you keep your money at home, it does not produce, it does not give any of them other money. Whereas when you keep your money to the bank, they will give you some portion of interest on that particular money. So you find that people try to go with these three types, and that is what helping them. Again, there are three types of deposit which we can say. First, we can say current account deposit. What is current account? Current account means it is mostly used by the commercial peoples or the businessman. So you find that they have day-to-day transactions. In day only there are many transactions which has been done. So for them there is a current account deposit. So we can withdraw anytime, any place, anywhere. So there is no interest being given in current account. Okay, again there is a facility of overdraft which is given to the businessman if there is having multiple transaction in a day and the bank balance is going in the minus, or it is going below the minimum balance which is there in the bank account. Then comes the saving account, which we as an individual try to keep or maintain. So we find that our some money is being saved and you get a small portion of interest on that particular money which have been kept for a longer period of time. Then comes the third one, that is fixed and long term deposit, which is also known as fixed deposit, or we can say term deposit. So in that we find that when you have lump sum money for a when you have lump sum money and it is been not used for a present time, but it can be helpful in a future time. So for that long period you try to go with keeping into the bank, and bank will give you higher rate of interest because you are keeping for a longer period of time. Again, if you want to go with that, again there is a recurring account in this fixed term deposit. That is, a recurring account means you don't have the big lump sum amount, but you can save a minimum amount, so you can deposit every month. So that becomes a recurring account, and every month you have to pay the minimum balance to your bank. So what will happen that time? You find that the same rate of interest is been given in the which is been given in FD. So this is how these are the types of functions which you find that is in accepting deposit. Then comes the provide credit facility. What is credit? Credit means giving loans. So you find that when an individual, farmer, businessman, or any professional wants for personal or business purpose loan, they try to go with banking system because there only there is so much of money. So they will try to borrow from them, and bank will charge them at a higher interest. Now there are different conditions where bank can give loan. So there is, first we can say for a longer period of time, for a short period of time. So short term, that is up to 1 year, medium term, that is 1 to 5 year, and long term, that is 5 to 15 years of borrowing can be given depending upon the person which has been there. Either is a farmer, investor, individual, professional, who can be. So for their personal reasons also the loan is being given. So that is what the second facility is being given. Third is the payment or withdrawal facility. So how, if you want to pay your money to other persons, you can go with different net banking system, RTGS, NEFT is there. So all this particular thing is been. Again, if you want, you can go with physical check, withdrawal slips. If you want to go with withdrawing your money, you can withdraw with the help of check. You can go with withdrawal slip, draft is been there. Then pay orders, ATM facilities nowadays mostly common, that is debit card and credit card, which have been there. And lastly you find that internet banking, or we can say e-banking, is been done with the withdrawal and payment facility. Then comes the fourth one, that is credit creation. Now this is a big topic, credit creation. What is credit creation? That is, bank when having surplus money, they try to go with giving out loans with the different rates, so that different persons can get attract with the rates and can take loan for fulfilling their facilities. So I find that bank creates money from existing stock. So how much money which has been left with them, surplus money, they try to go and create, we can say, loans. So that is called as credit. So here we can say this credit, when it has been increased by the bank, you find that they try to go with more supply of money. Now here again you find that bank cannot lend the full amount of money. Here you find that depending upon the criteria they have to give, so they need to maintain cash reserve ratio, also they have to maintain SLR. We have already studied in the last, we can say, functions of central bank. So this particular thing they need to maintain so that money can be there. If not, what will happen? Bank cannot lend the full money to the people. If it has been lended, it has been, bank can get, like scams can be done, like Nirav Modi and Vijay Mallya. This all things will happen. So this is how it has been done. So here, which have been example, you have to go with that particular video where I have explained in detail. So this is very easy. You have to maintain a minimum balance. Okay, if you have deposited 1000, 20% that is CRR, that will be taken by bank, and 800 which has been left, that has been given as a loan, and this continues, goes on and goes on. Then comes interbanking transaction. Interbanking means from bank to bank how you are transferring. So you find that we have studied about call money. So call money is been there. So notice money is there. So this is type of money which we try to go whenever the bank requires money, it can ask from another bank for a short period of time, that is for 14 days. 1 to 14 days you have to return up, and there is a charge which has been taken up. Again, the secondary function. Now secondary function has two functions. First is agency and utility services. So what does the, apart from money value or accepting money, what is the thing which they do? So agency function talks about that it provides different types of facilities. So services, like it becomes an agent, it gives facility to the back customer, it gives you letter of credit if you are exporting any goods or importing any goods, sorry. So that particular time you find that letter of credit is very important, so that is been given. Then after you find that it becomes underwriter. If you are forming a new company and you feel that your shares will be not purchased by the people, so that time you can take bank as a guarantor. Then after you find you can go with paying your tax with the help of bank, so bank will directly pay your tax at the limited, means whenever there is a time which you have to pay. So all that particular thing, again it provides like utility services, like safety walls are given, so where you can keep your we can say precious jewelries, or we can say some of the confidential documents. So this particular type of thing is been given. Lastly, you find that microfinance facilities also given to the small businessmen. So these are the different agency and utility services which has been given. Second type is that is provide various facilities with changing time. Now you find that different, as time has changed, you find that people used to withdraw from withdrawal slip, then after came to check, then after came with the ATM cards, and now you find that mobile apps are there. So we can say the transactions of that money can become very easy nowadays with the help of technology, and it has been done. So facilities, if you want to go with more amount, you can go with NEFT and RTGS. Then after, mobile banking app is there. If you want, you can trade in your shares and debentures with opening up a DEMAT account. So this is how you find that the different facilities which are being given by bank to the customer also when they have surplus fund. So this completes your functions of commercial banks. Now how this commercial bank came into existence, you find that it came after an economic reform 1991. You find that many of the financial companies have made this particular, invested in this, and made unorganized sector into organized sector with money markets. So there are different types of money market. It is organized also, which is bank and financial institution, and unorganized, like we can say private money lenders, shops and other persons who try to give this particular money. Then after, you find that the definition says about scheduled bank, that is the official definition of bank in India, that is only those of companies which are listed in second schedule of RBI Act 1934 are called scheduled banks. So those who are listed in the second schedule of RBI Act in 1934, that particular banks are called as scheduled banks. So they need to follow all the rules and regulations of RBI, that is Reserve Bank of India. Then comes the classification of scheduled banks. So how this particular structure has been divided. So we know that scheduled banks is there, which is following RBI rules. Now they have commercial banks and cooperative banks. Again, commercial banks are having 4 subdivisions, that is we can say public sector commercial banks, private sector commercial banks, foreign banks in India, for regional banks in India. So this is a classification of bank which has been there in our country. Sure. So now central banks. What is central bank as per the R.P. Kent? He defines that as an institution charged with an responsibility of managing the expansion and contraction of volume of money in the interest of general public welfare. So he says that for, we can say for general public, how you can do more and more development and expansion with the help of managing the money for the overall economy. It is not talking about the individual person or a bank. It is talking about the whole we can say economy. So that for that we can say R.P. Kent says the everything should be done, expansion and contraction of money for the interest or for the welfare of the general public. Or you can say in simple sense, central bank is an apex bank. Apex means the topmost bank of the country, where you find that it is its function is to help, regulate and promote the entire money market. So how the money flow is been going, you need to regulate, you need to check, you need to purport, so that banking sectors get more amount of money, so that people will have money in their hand, as well as to maintain monetary and financial stability over the economic goods of the nation. So you find also they have to go with the dealing with the situation like depression situation. You find that the situation like inflation has been there. So all these situations are being we can say controlled by the RBI, or we can say central bank. So with everything keeping in mind, they need to do with this particular regulation and promotion of money in the money market. Then Reserve Bank. So that was a definition for central bank and things. What is actually Reserve Bank of India? So Reserve Bank of India, that is known as RBI, it is a central bank. It is a main bank of our country where all the banks follows the rules and regulations of RBI. That's why it is known as Apex Bank. Now you find that how it has been made. It has been established in 1st April 1935 under RBI Act 1934. So first in 1934 Act came, and then after it, on the 1st April in 1935, that is the next financial year, they made this RBI with a capital of 5 crore rupees. Now RBI became nationalized. That time it was a private bank because we were under the British rule. After you find that after 1947, you find that in 1949 on the January, RBI became nationalized bank, and then after it became the Apex Bank. So you find that this is how it went, and its function is to supervise and regulate all the banking sectors in the economy, so that money policy is being circulated properly. So this is the main function of RBI. I hope you have been very clear with this. Then after, there are functions of RBI, that is monetary, that is money function. Monetary means money. So monetary functions are there and non-monetary functions are there. So again you find that I will just quickly go with that. I will not go in the detail one, that is currency issue. So what is happening in currency issue? RBI has the right to issue the currency of all the notes from 2 to different notes starting from 2, whereas you find that rupee 1 note and coins are being maintained with the government of India but under the guidance of RBI. Then comes the banker to the government. Like quickly go, just revise it up. So you find that here rupee 2 notes are being issued from rupee note 2. You find that it has been issued by RBI, but compared to notes and coins of rupee 1, you find it has been done by the Finance Ministry of Government of India but under the RBI only. Then after you find that banker to the government. Now our government is very big, our country is very big, so you find that all the government, central government, state government accounts, everything is been handled. Central government accounts are being handled by the RBI. So all that monies are been there with RBI, and they try to regulate and they try to go with all the accounts and auditing work of the different state. Then comes the, you find that bankers bank, and you find that lenders of last resort. Now what is happening? A bankers bank means all the commercial banks are been under the RBI. All the commercial banks or every bank which are been there, it is under, they are follow the rules and regulations of RBI. So everything they need to go. So they try direct, they try RBI try to direct, they try to go functioning, giving different types of funds in the case of emergency also. So it becomes the lender of the last resort. So whenever it is an ultimate emergency and another bank is not able to give money, that time RBI try to go with giving money to the scheduled banks. Then after, credit control. What is credit control? Again you find that the flow of money, if the flow of money is more in the market, it creates an inflation situation. So you find that that time RBI try to go with increasing the rate of interest, or we can say increasing the bank rate, so that you find that the loan rates will increase. So this is how you find that they try to control. Again same way, if the supply of money is less in the market, that time they try to reduce the rate of loan, so that bank can give more amount of, bank can create more amount of credit creation. So this is how the credit control is been done by the RBI. Then comes the 5th point, that is custodian of foreign reserve. Yes, the main point, because you find that many of the, there are so many transactions which are being done, many of the goods are being sold outside and purchased from outside, import and export. So you find that there is a lot amount of goods dealing with this particular import export trading work. So that time you find that currency is been required. So RBI need to maintain the currency, foreign currency, for the payment purpose also, as well as for the, we can say, advance purpose or the receipt purpose also. So they need to maintain this particular Indian currency. Also they need to maintain the value of the our currency in terms of foreign currency. So it becomes the custodian for Indian reserves, as well as it try to check what is the inflow and outflow of foreign currency. Then comes the non-monetary function. What is non-monetary? That is not regarding with the, we can say, money, but it gives us different things like regulation and supervisory function. So RBI try to regulate and supervise the function, scheduled banks, non-banking companies, cooperative banks. So different banks which are there in India, they try to look over the we can say functions, how it is being given, what policies are being there, all these things are being known to the RBI. Then comes promotional function. You find that they try to promote different we can say awareness programs or promoting different rural expansion schemes or yojanas which is been made by the government. So all this particular thing is been done. Then you find that it makes transactions in cash rather than check. Then after, it helps the farmer with providing the money. All this particular thing is been done by the we can say RBI. It also makes company to do advertisement for them, so that people will get more and more knowledge of banking capacity and bank. They try to keep their money, not they does not keep in the private bankers, but give to the, we can say, this particular banks. Then we can say function financial inclusion and development. Now it provides different efforts of banking spheres are there. So you find that they try to protect the interests of the customer. That bank is a proper bank, you find you need to go with a proper bank for taking loans, different interests, so that they does not cheat you anything. So all that particular efforts are being made, so that you find that credit facility to be given to the farmers, agriculture, small scale industry, self-employment people, traditional, all that they get a good effort or good amount of money, and they need to have the more awareness, so that they can expand their banking expand their business also with the help of this particular banks. So they need to go with RBI policies. Then comes the monetary policy. Now what is monetary? I told money. So the money policy which has been done by the government. So from the earlier time only, the purpose of monetary policy was what was that you find that it is, they need to regulate the money. They need to see that whether the money, how the money is been going in the market, it is the money supply is more or less. So present time you find that monetary policy is known as what? Credit creation. Now credit creation again talks about the how money can be expanded, more and money is being lent, so that more and money profit is being earned by the commercial organization, and there will be more supply of money in the economy. So then there is a definition which has been there. So here the definition says that in simple terms, the policy undertaken with the apex bank for regulating the supply of money. So they try to regulate mainly the supply of money in order to maintain economic stability. If they come they take the control of on the supply of money, what will happen? They can make stabilization, or there is a equilibrium in the economy, so that the process of economic development is goes on, and you find that public interest is also maintained. So these things should be done with the monetary policy, and it has been done by the RBI. So again, there are instruments of monetary policy. It is called quantitative measures and qualitative measures. Now quantitative measures talks about the general measures which impacts all the entire economy, entire sector of the economy, whereas qualitative measures only affects the small portion or some sectors only, not all the sectors. So the impact is on the some sector, but that impact is again going on with the all the sectors. So let's go quickly with this particular two types of measure here. Qualitative measures, that is talking about bank rates, and 7 type of it's there. I'm just quickly going with each and every one detail. I have done the slides. So here qualitative is there, yes. So you find that, sorry, bank rate. So what is bank rate? When RBI try to we can say when commercial banks is having shortage of funds, you find that they try to purchase they try to borrow the money from RBI, and RBI gives or lends money to these commercial banks. That time you find that the rate is given, that is called as bank rate. So if the bank rate is increased, the commercial will increase the more rate of interest, and they will purchase less because they will borrow less. The rate of interest is rate of interest is high, that's why. So here you find that when bank rate increase, you find that commercial banks will borrow less, and when bank rates are less, they will go with more funding, so that general people will go with having more loans. So they try to control with bank rates. Earlier it was being done with the bank rates. If bank rate here in 1953, if you see, it was 3.5, then 1981 10%, 1991 you find that it is 12%, and 2016 it is not clear here, it has been mixed. So here it is 2016, it was 7%. Okay, remember it is 7% in 2016. So you find that. So what they try to go with, if the bank rate is high, the commercial will purchase, commercial bank will borrow less funds. When they purchase less funds, the less supply of money is been there. When the bank rate is less, they try to go with taking more of fund, and you find that the more supply of money can be done. So RBI try to look out the situation and control the bank rate, but in bank rate it become the overall market. It is used for longer period of time, it cannot be used for short period of time. That's why this particular trends have been stopped from 2016. Then they started making with repo rates and reverse repo rate. So what is repo rates and reverse repo rate? You find that repo rates here talks about whenever the commercial banks need money, they try to for a short period of time, they try to sell their securities in the sense shares, debentures, government bonds, mostly government bonds which are there. It is being sold to the RBI, and RBI gives money on behalf of that is repo rate. Again RBI promises that I will purchase it again after I will give you the give you back the securities, and commercial banks have to guarantee or give commitment that I will again purchase it. So that is reverse repo rate. So this is how you find the repurchase of securities which has been done by the commercial banks from the RBI, that is called as what? Reverse repo rate. So here the rates are being given up, that is 6.50 was there in 2006, that is repo rate. Reverse repo rate 5.50. It is always less. Then March, so 5% is there, and reverse repo was 3.50. April 2016 6.5 and 6. Currently it is 4% and 3.5%. Chalo. Stabilization under emergency situation. So whenever there is a quick emergency situation, you find that there is a marginal standing facility which is being given up. So in that emergency situation, you can use your government security directly to the RBI, and the RBI give you money in the emergency window. So there is a special window which has been created so that from RBI you can borrow, the commercial banks can borrow money for emergency situations, and they can directly get the cash. So that is called as marginal standing facility, and the rate is always higher than the repo rate. Then after cash reserve ratio is again the ratio they have to maintain by the bank. That is, for example, if the deposit came of 1000, if the cash ratio is, we can say 10%, they need to maintain the 1000 out of that 10%, that is 100 rupees they have to maintain, and again remaining 900 rupees are being helped for creating credit creation. So it started from we can say since 1962 there is a variation of 3 to 15% only, but you find that if this particular rate becomes higher, there we can say the credit creation is less. Again, if this particular CRR becomes reduced, there is more credit creation which has been happening up in the market. Now then after statutory liquidity ratio, that is SLR, it again talks about the maintaining some percentage of fixed deposit, that is long-term deposit, fixed deposit money which has been there in the form of cash. 25% is the it is not less than 25%, so it should be nearly 25% which has been SLR, which has been kept. So this is how it has been there. So RBI try to maintain the CRR also, and SLR, RBI try to go with giving commercial banks order that commercial banks has to maintain the CRR as well as SLR, so that whenever there is a time of money, when there is a flow of money is less, that time they try to go with this giving money also to the people. Then comes the open market operation. Again here open market talks about buying and selling of government securities bonds by the RBI in the open market. So whenever they want money or they try to sell or purchase this particular government bonds in the open market, whoever wants the to invest in this, they can purchase from RBI, and RBI can get the money. So this is also one point or one of the functions of RBI. Then after you find that sterilization of RBI accounts. So RBI try to check, or we can say analyze about their balance sheet, everything, what all the things happening up, what is been done in the open market, how much percent of sale and we can say purchase of government security is been done, how is the foreign investment is been going on, how much foreign reserves have been there, everything, how much government bonds are there with them, and what is the outflow of the foreign exchange, everything is been done here. So that gives us account, and they know whether the government is in losses or profit, everything by sterilizing the account. Then the qualitative changes, that is selective measures, that is security requirement. Security requirement talks about the whenever you want to go with taking money, so bank try to ask security. So what type of securities, if suppose you're going with taking a car loan, so they will ask certain type of securities and they have to go. Same way, if you want to go foreign, you find that you need to go with keeping your jewelries or car or house, or sorry, we can say house mostly, or a properties to as a security, and on the basis of that only they try to give you loan. And they will when you return the loan, you give they will give you the properties also. Then comes the second one, that is margin requirement. Margin requirement talks about they will grant you only some margin. So they will take some margin with them, like for example, if you are having a house of 1 crore rupees and you want to go foreign, so you find that you want to take loan and you keep your papers of your house to the bank, they will give you near to 60 to 70% of your loan, and 30 to 40% it has been kept by the we can say bank. So this is how we find that the total value is not given, but some margin is been taken up by the bank, and apart from that remaining things has been given up. So this is how it find that margin requirement. Then after sealing of the credit, if you have taken more and more amount of credit and you have not repaid, your accounts are being seized and you are not able to take another further loans, no matter how much big persons you are. Then after you find that discriminatory interest rate. Yes, discriminatory means there is a inequilibrium or inequality of interest rate amongst the thing. So you find that there are different rate for different persons, like businessmen, farmers, investors. So policy of discriminatory is been there, and this is where you find that the lower rates are given to the farmers and the rate of interest is high for the rich businessman. So for this particular thing, there is a discriminatory interest rate which has been there. I hope you have been understood with all the points. If you find again, you can just go with the videos and you can ask me the doubt also personally. So go with everything. We'll have test next week, so you need to write down the notes. I will be checking on the Monday the notes for all the chapters. You need to send me the PDF file, or by clicking the photo of your notebook from the first page till this particular fourth chapter, discriminating interest of rate. I know how much pages should be there. I know everything. So do not bluff or cheat me, or do not send another's PDF file. Okay, you need to go with your parent's signature or your name and your signature also. So this how I will be checking, or else if I find it has been doubt, I will ask you to come to show me personally, or else I have to visit your home. So don't go with that particular thing. Be uh, go with a two-way process. You have to do work, we are doing our work. You ask doubts, I will be available to clear all your doubts. So many of your students are not attending the test also. I don't want that negligence. From next week it will be more strict, and we will try to make calls as we have seen your negligence. So go with this week is there, complete it by the Sunday everything, and I want the notes by Monday. Thank you.